talk is about the secondary market for private equity investments. And so what does this mean? Okay, well, in order to understand about the secondary market, I think it's important we kind of know a little bit about what private equity funds are and how they work. And one of the things that private equity funds do, I mean, what private equity funds do is they make investments in private companies. And when you think about a stereotypical company that they would invest in, you might think of a startup, you know, your Uber or whatever, that sort of stays private for a long time, and they get lots of rounds of funding, and eventually they are sold and go public and have an exit. But while they are private, they're illiquid. There's no buying or selling them. And so the funds that provide the capital to these private companies are equally illiquid, so that if you are an investor in one of these funds, you cannot get your money back for the simple reason that the fund can't, it's not like a mutual fund, right? If you have a mutual fund and you want your money back, and and the mutual fund doesn't have any extra cash, they can sell one of the stocks in the portfolio and then transfer the money to you. Whereas if the private equity fund has invested in Uber or some buyout, they can't sell it, right? So basically, it's sort of fundamentally illiquid. It's not just illiquid because somebody chose it to be illiquid. It's sort of illiquid because it's sort of fundamentally that's the nature of the game that you do. Okay, and this can create a problem for investors. And why does this create a problem for investors? Is because sometimes they have an unforeseen demand for capital, and this happened most famously during the financial crisis of 2008, when lots of investors in private equity funds wished to exit their investments because the universities had to pay salaries and keep up other commitments, but they had made these long-term commitments. Another thing that happens is that investors, they change their mind and they wish to exit an investment. At Ohio State University, we've had several different managers of our endowment, and they all have different philosophies. And one of them didn't like venture capital, and then the next one wanted to get more into venture capital. And then when they change, they want to change the investments, and when the investments are very long-lived, that creates a problem if there's not a market. And so the way to see it is, this is the picture that I use in my private equity class about the way that funds are structured. So basically, in the first year, there's marketing, and then during the first part of the fund's life, the first 5 years, they draw down capital from investors, and eventually they realize the returns and they exit. And then in the last 2 years, there's normally, the GP has a right to extend the fund's life, and they often will take this up. So funds can last 12 years or sometimes even longer. And so this is a commitment that the fund and the investors in the fund make. And, and often it's totally fine. They plan for not getting their capital for a while, but sometimes they change their mind and they want to get their money back. And I just have a few slides here about the amount of money that's in this sector, because some people don't realize quite how much. But basically, in the last couple of years, almost $1 trillion has been raised every single year in various forms of private equity funds. Another way of looking at it is in terms of what's called dry powder, which is the amount of capital that is committed, but not yet drawn down. And so that is, as of the end of 2019, 2.5 trillion with a T dollars. And I'm pretty sure the number is even higher today. So there's an amazing amount of capital that's been committed that has not been yet drawn down, but still the investors who've committed the capital don't have the right to uncommit the capital. So they are committed whether or not they want it or not. And so some of these investors will wish to change their mind and exit, and this is where the market came up. And so to see, I think it's useful to think about a particular fund. And so this is a fund called Blackstone 5, which was one of the mega funds that was raised before the financial crisis. And so what you see here and the blue lines are the quarterly cash flows. So this would aggregate all transactions in a quarter of Blackstone 5. And you see that in the first few years, the blue lines all go down, which what that means is that there are negative cash flows, which means that the Blackstone was drawing down capital, and so then, in making investments, and this was a buyout fund, so they were buying out companies. And so by the time you get to 2011, it had invested most of the capital, and the yellow line represents the NAV, which was more than $10 billion at that time. And then they made their first major exit in the second quarter of 2011, which is that big blue line there. And, and the NAV went down a little bit. And you can see that still at the end of this picture, which is in 2014, it still had a NAV of around $9 billion. And so ultimately, those deals were exited, and I think the fund did okay. It wasn't Blackstone's best fund, but they did around, maybe 10% IRR on the whole fund. But the point I'm trying to make is that once you're in the middle of this fund, all the Blackstone didn't have a whole lot of capital sitting around its bank account. Basically, every time it did a drawdown, it bought a company. And so the assets, in 2011, when the NAV was over $10 billion, that was essentially the book value of all the companies that it owned, but it's not something that Blackstone was able to access if it wanted to. So what happened, and the way I think about this is, way back when I used to teach economics, I used to give the example of in New York City, if you were to go to the theater, and there was a surprise thunderstorm in the middle of the theater, and it was pouring rain at the end of the show, then what would happen is that magically all these little guys would appear. They're selling cheap umbrellas, and they, for $5 or $10, you could buy a cheap umbrella that you could use to get to the taxi or walk home or whatever, and then throw away at the end. And the point was that there was a market for this, and one of the principles of economics is when there is sort of demand for a certain product, that suppliers will kind of appear out of the woodwork because they can make money by providing that product, and so that's one of the sort of miracles of the way markets work. And this is how I think about the secondary market for private equity funds, because what happened was, in the early 2000s, there was some guys came along, and they said, well, there are all these investors who have these long-term commitments to private equity funds. Now, some of those investors are going to want to sell their commitments, but there's no real way for them to do that. And so why don't we create a marketplace whereby the buyers and sellers can come together, and basically what our marketplace will do is to turn an illiquid asset, i.e. a stake in a private equity fund, into a liquid asset, which is something that the limited partners would value more highly. And so, of course, since the general partners, who are the ones that are selling the funds, would much rather sell a liquid asset than an illiquid asset to their investors. They were excited about this. And so the market was created whereby investors can trade their stakes in private equity funds. The other thing that happened was that as soon as this market got created, that there were new private equity funds that were really funds of funds that were created to purchase the stakes of the people who want to sell their funds, and these are called secondary funds. And so it's a huge business right now. So right now Blackstone has I think over $60 billion in secondary funds that they operate, and they're just one of the players in this market. So in other words, what happened was, because of this illiquidity of these assets, a market was created, and then buyers sort of appeared out of nowhere to purchase these funds, and so that's kind of what happened. And so the transaction volumes have increased dramatically from less than 10 billion to over to over $40 billion. And so and the thing is, though, it's still a very small fraction of global private equity exposure. So it's still less than 2% of global private equity volume. And so there's every reason to believe that this market is going to thrive and continue to grow in the future. So, and so the way the market works that these guys were they created was that the selling firm would, when I say selling firm, I mean the selling investor. So the investor would be, you know, I teach at Ohio State, so we have an endowment. I don't believe we're selling anything, but if we did want to sell something, we would approach the intermediary to sell a portfolio of holdings. And what would happen is the intermediary would facilitate the transaction, and they will conduct some form of an auction to identify a buyer with the highest willingness to pay and to execute the transaction. And it's a little bit more complicated than selling a public security, because what they're selling are private securities. And of course, while the private securities were being owned by the private equity fund, they gave private information to the limited partners, and then nobody's going to want to buy these shares into the private equity fund without having all this information. So often the people who buy are these funds of funds who specialize in buying, or investors who already buy, but the intermediary has to have the cooperation of the general partner, which they normally do, and they distribute the information about all the portfolio companies to the potential buyers. And the prices are always stated as a function of NAV. And just a word about NAV, that was the yellow line I showed you on that figure earlier. NAV in the private equity world is essentially the book value of the investments. And this is often confusing to finance professors because we are so used to hearing about NAVs as like the market value of mutual funds. And so NAVs in the mutual fund world is the market value of all the securities that the fund holds, but NAV in the private equity world is book value. So it's one of these confusing things that, you know, you kind of wish they had different terms, because the NAVs in the private equity world are a different thing than NAVs in the mutual fund world. So and so what happens is, if they can agree, then the buyer would buyer would purchase the investments that the seller has already been made at the agreed price. And the key thing is that the buyer would receive the cash flows from these investments and is responsible for all future drawdowns of capital. And so this picture, and I just, as an aside, this picture was created by one of the discussants on one of my papers. And so I want to thank the discussant, and so anyway, so it's nice when discussants provide services to authors this way. So basically what this picture illustrates is kind of the time series of a private equity fund and how this transaction would occur. So at time 0, investor A would commit X, and there were calls, or they're called calls or drawdowns, over the first few years, and those are the purple lines that are going down. There could be proceeds that would return to A, but then at the time T, there would be a transaction, and there would be and the blue bar, vertical bar, would represent the NAV of the unexited investment, and the purple line with the arrow at the top would illustrate the price that they agreed to, whereby the buyer would buy the assets from the seller, and then after that point there will be future drawdowns, and investor B, who purchases the stake in the private equity fund, would be responsible for all of the remaining deals. So that's kind of the way the market works. And this is a picture of the volumes in the market, and so as of 2017, there were 58 billion transacted in this market. and it's much higher today. I should get the more recent numbers for when and update these slides at some point. And so the transactions per quarter, you can see it's grown substantially. And again, I think it's important to understand, if you want to understand the market, you understand why the buyers and the sellers are in the market. Okay, and so the sellers, there's a bunch of different reasons why they sell. The reason that we thought was most common when we started this project was just liquidity needs. So we all think about the financial crisis and the fact that you heard that Harvard and Stanford were desperate to sell their positions. But if you talk to the people who work at the intermediary that does this, they claim that, and I think this is true, that is not the predominant reason why people sell in this market. Mostly it's the changing the composition of the portfolio manager, changing strategies, desire to adjust portfolio risk. And another key reason why they sell, which we had not actually thought about when we started this paper. Again, one of the things I like when I write papers is to actually not just kind of get results that I expected when I started, but to really learn stuff about the way markets work. And one of the key parts of this business is to clear the books of tail end positions. So often what will happen is you will there will be a private equity fund, and suppose they make 15 investments in their fund, and after 8 or 9 years, or even 10 or 11 years, they've exited maybe 13 of the 15 investments, and there's only 2 more portfolio companies that the fund owns. And so when the limited partners call the general partners, they say, well, what about those two companies? The general partners say, well, we could liquidate them for nothing, but we think that if we hold it for 2 more years, we could get a decent amount of money for it. And so what are the LPs going to do? So they, of course, they say, okay, well, do your best. But then often they don't want to hold on their books a private equity fund that basically is almost exited. So if somebody comes along and offers them a decent price for it, they'll sell it. And so you see a lot of transactions of what are called tail end positions. And then now from the buyer's perspective, they reduce what's called the blind pool risk. So in other words, often when you invest in a new private equity fund, you don't know what they're going to invest in. But if you invest in an existing private equity fund that hasn't exited most of its investments, you kind of can look at what those investments are and decide if you like them or not. So that's kind of an advantage if you buy on the secondary market versus on the primary market. There's earlier return of capital, so it's a shorter duration. It's a shorter commitment on the part of the buyer. And another thing that is really kind of important is that you, especially not so much today, but previously in the early days of these funds, this market, that you actually would purchase the funds at a discount, and it's important to remember that the discount is relative to the NAV. And remember, the NAV itself is the book value, not the market value. So in general, if the fund's doing okay, the book value will be less than the market value. So that what you end up doing is, if you can purchase at a discount to the book value, then you purchase at a really big discount to the market value. And so if you can buy into a good fund at a discount to the book value, the potential to earn big returns is there. And as I will show you in a little bit, the investors that bought into funds at discounts earned enormous returns, and so they did super well. Now, more recently, the discounts have gone away, but still, if you buy at even if you buy at NAV or even a small premium to NAV, you're still getting a discount relative to the market value of the asset you're buying. It's just that you kind of know what the market value is, because it doesn't exist. But if there was kind of a true market value of what a fund would be selling at, if it was public, that you'd probably be getting discount to that market even today. And finally, the buyers can get access into a fund that they cannot get access to in the primary market. So one of the other kind of interesting aspects of private equity is that many funds they're oversubscribed, and they, especially the prestigious funds, especially your A-list Silicon Valley funds, especially, you can't get in if you simply call them up. So if your endowment is not an investor in one of Sequoia's funds, and they were to call up Sequoia and say, I want to purchase into your next fund, the person on the phone would laugh a little bit and say, get to the end of the line, because Sequoia generally will raise $1 billion or less in a fund, and if they took all the capital that they were able to get, they would be well north of $10 billion, given the returns that they could earn. So by buying in the secondary market, it's sometimes possible to buy shares in a Sequoia fund, or a Kleiner fund or benchmark fund that you could not get access to if you were to purchase in the primary market. So we had a number of questions about the secondary market, and I'll try and go through go through some empirical works in the next 15 or 20 minutes, and then I'll take some questions from you. But basically, we wanted to know what kind of funds transact in the market, what prices are paid in the market, what are the returns to buyers and sellers, and how do these depend on market conditions, fund characteristics, et cetera, and what types of investors tend to be buyers and sellers in the market. Oh, I should add that this talk is based on 2 papers, and so these questions are from the first paper, which we published a year or 2 ago, and that's with Taylor Nadal, Burke Sensoy, and Keith Vorkink. And I'm going to talk at the end of this talk a little bit about some results from a second paper, and that is not yet published, and that is with Brian Boyer, Taylor Nadal, and Keith Vorkink. So these are all from the paper that was published, I think in 2019 in the JFE with Burke, Taylor, and Keith. So what we did was we addressed these questions, and we were fortunate enough to get access to a proprietary data set. So my co-authors actually knew one of the founders of one of the early funds. And so the data provider, I'm not allowed to say the name of it, but it's a little bit of a weird thing, because if I told most finance professors the name of it, they would not have heard of the data provider. But if I told practitioners that I have funds from one of the largest intermediaries, they would, in the first or second guess, they would know exactly who this is, because there just aren't that many intermediaries in this market that could be providing these data. So with that being said, they were extremely kind, and they provided us with essentially all their data from the 2006 to 2014 period. And for the second paper, they were actually great, and they updated the data, I think, to the end of 2017 or 2018. So we have lots of transactions, 2,200 transactions, and 1,800 of them were of venture capital or buyout funds. The remainder were of real estate private equity funds, and so we don't look at them in this paper. And so what we do is we really want to compare. To do the calculations we want to do, we really need what is called cash flow data, and we get that from another source called Preqin, which is this is a public data that you can buy, and so that enables us to calculate the returns to the buyers and the sellers in this market. And so sample was dropped to 700 transactions, and so to characterize the data. There were more trades of buyouts than venture, and the buyouts had larger than average discounts, and the venture capital had smaller than average discount. There was a fairly uniform distribution of transactions between 2007 and 14. That's 200 or 300 per year. And again, these are just the transactions that our intermediary does. There are other intermediaries that we do not have data for. So we do not have data for the complete market, but we have data from this one intermediary that represents a good fraction of the market, roughly 30 to 40%, I believe. And in the financial crisis, what happened was there was there weren't actually that many transactions, but the discounts, it says low discounts, but that means a low price, a high discount during the financial crisis. And compared to the universe of funds, larger funds are more likely to trade, younger funds are less likely to trade. So in other words, what's going on is that in order for this market to work, the asymmetric information has to be minimal. So if we were to talk about a small venture fund based in Columbus, Ohio, or wherever you happen to be located, that they would be invested in a lot of little portfolio companies, and potential buyers really wouldn't know much about those companies. So they would be reluctant to buy stakes in a small fund with with portfolio companies they don't know about. And so those funds tend to be less likely to trade in the secondary market. But the larger funds, those are the ones that are hundreds of millions of dollars or even billions of dollars, they are more likely to transact. So basically, I can't give you a list of the funds that can transact, but because again of the rules the data provider gave us, but basically, if you think about a large mega fund, it's likely in our database. And if you think about a small fund that is relatively unknown portfolio companies, that's less likely to be in our database. So the three types of transactions, and what we call they call them what we call the standard portfolio transaction. So those are 4 to 9 years old funds, which are 60% of transactions. Those are typically investors managing away from the manager or the sector. So actually the people at the intermediary, they call these fairway transactions because they say these are just down the fairway. So you can guess what sport the people who work at the intermediary like to play when they are not working. So then the second type of transaction are these tail end transactions that I told you about, and those represent 30% of all transactions. So there's a fair number of them. And finally, there are what they call green transactions. So in the green transaction, the fund makes a commitment. They may not have even the limited partners make commitments to a fund. There might not have even been any transactions where they purchase portfolio companies, and by this time they and they say, oh my God, we made a mistake and we want to get out. And so the investors need liquidity, and often these sell at big discounts, but that's very misleading because remember, the discount only applies to the investments that have already been made. And if most of the investments haven't been made yet, then the discount really doesn't matter that much to the selling firm because it's a discount relative to only the drawdown capital, which may be very small or even zero at that point in time. And so one thing we do is we want to, I think it was interesting in the first paper, is to calculate the returns to the buyers and sellers. And so what the prices are and what the returns are. And so on average, transactions occur at 86% of NAV. Now, again, remember that's 86% of NAV, but if NAV itself is at a discount to market value, then that might be 60 or 70% of the true market value. So these are actually fairly big discounts. And when we construct buyer and seller returns, what we do is we look at the cash. This is where we need the cash flow data, and look at the performance relative to buy and sell. And you can see the buyers do really well. They earn almost 20% IRRs, and the sellers, they don't do so well, right? They earn a 2% IRR. And but the thing to remember is that the sellers want it out. They still get out, and they still they don't lose money on the deals. And so that basically that's the way the market works. But the way we interpret these numbers is that the effective price that is paid is that it's sort of discount to what it would be and if it were sort of the fair market price, because if there was a fair market price, in a sense it is the fair market price, but these are prices that are at a discount to sort of the true value, so that the buyers tend to do better than the sellers. and what factors do the prices and the seller returns, what are they associated with? Well, they're associated with the market conditions, fund agent size, transaction size, and basically we view them as generally consistent with microstructure theories that emphasize asymmetric information and market depth. So in other words, when there's a lot of buyers and sellers, the discounts are lower. When asymmetric information is high, the discounts are higher. And that's kind of the pattern we observe in the data. Okay, who buys and sells? Well, the sellers they're very different kind of institutions. So it's not the case that, typically in this market, one is either a buyer or a seller. It would sort of be unusual to be both. The sellers are typically traditional pension funds, endowments, foundations, financial institutions. So these are investors who buy the fund intending to hold it for the fund's life, but then change their mind. Then the buyers are likely funds of funds. So the typical buyers are these funds that have been raised for purchasing assets in the secondary market. And what happened was the returns that I just showed you are pretty close to the returns that these secondary funds achieved in the early years of the market. And so therefore, there's been a lot of money raised by this in this sector in recent years. Now, there are also some other buyers. I think the Chinese government in their big fund that they run was actually smart, and they purchased a bunch of stakes in private equity funds, and they did very well across it, for example. So the results on the transactions cost, basically the market is developed to transact stakes in these funds. We use proprietary data to analyze the market, and the cost of liquidity through secondary markets transactions is substantial. They traded a discount to NAV, and it's larger than 50% during the crisis period. It's smaller for larger funds and larger transactions. Buyers outperform sellers, even adjusted for the market. And we think that the discounts are consistent with the microstructure theories. And so these are kind of the first set of results in the first paper. And so the moral is that these are still, this private equity fund should still be viewed as a fairly illiquid investment, in the sense that, you can exit them, but if you do exit them, the transactions costs are fairly substantial. And hopefully in the future, especially in the mega funds, these transactions costs will be lower. Now, the second paper, which I'll talk about briefly, has to do with the nature of secondary markets, and what we do in this paper is we create an index of private equity returns. And the logic is the following: that if we think about the way about illiquid investments, the way we normally measure the returns of them is by some index, right? So I always think of my mother when I think about purchasing bonds, because my mother is a widow. She lives in Michigan, and so what she does for her portfolio is she purchases municipal bonds that are issued by municipalities in the state of Michigan to fund a school system or a road or something like that. And these are relatively small bonds, and there's no secondary market in these bonds at all. However, when she gets her statement from her broker, the prices of the bonds do change. Well, how do the prices of the bonds change if they don't transact? Well, they change because there's an index out there of bond activity. So basically, there are some bonds that are liquid, that transact, and when interest rates move or something moves in the macroeconomy and the prices of those bonds change, the index moves. And so the broker that has my mother's bonds in her portfolio, they will use what's called matrix pricing, and they will use an algorithm and come up with a market value or estimated market value of her bonds. And so what we thought was we could construct an index using the secondary market to price private equity transactions in the same manner as they do, as is standard to price bond markets, right? And so let me just kind of skip ahead. And just one fact is that I think that people, by not using an index, can actually make some misjudgments. And the one that always comes to mind is during the financial crisis, because during the financial crisis, those of us who are old enough to remember it, if you looked at what practitioners said and what they did, they would say, the people who ran large institutional portfolios said that they were overweighted in private equity relative to public equity. Well, what happened? Well, the prices of public equities declined a lot. And the private equity positions in their portfolios were being held at book value. And so they were being held at book value before the crisis. They were being held at book value after the crisis, during the crisis, and they were being held at book value after the crisis. And so what it looked like, if you were just looking at the way they accounted for the positions of their securities, was that private equity was a much bigger fraction after the crash of the public market than before the crash of the public market. Well, as I will show you in a few minutes, we believe, my co-authors and I believe, that the true value of the private equity stakes declined by at least as much as the public market during the financial crisis, and our index shows that it does, but it's just that they weren't being held at this stake. And so that rather than being overweighted in private equity during the financial crisis, we think that they were held at approximately the same weights, or even a lower weight to the public markets during the crisis than and before the crisis. That doesn't mean that they were wrong to sell their positions. It's just that they were looking at the problem all wrong, because they weren't using they were using market prices to value the public securities, but not the private securities. And so let me just skip ahead and show you how we constructed our market, our index, and then I'll show you the index, and then I'll stop and take some questions for you. So basically what we do is we calculate the index by looking in the same way you calculate any return, by looking at the change in the price plus the distributions minus the drawdowns over the time. You convert it to a return, and instead of using actual prices, we use inferred prices, and that's all we do. And then we come up with this index, and you can see that the solid line that says, it's too bad this isn't in color, but the solid line that says secondary private equity transactions, that is our index. And you can see that it bounces around a lot. Now, if you look at the next three beneath it, this is called the Preqin NAV, which is an index we constructed based on the NAV using the same formula as I just showed you, but instead of sticking in market values, sticking in NAVs. And then there's one that's constructed by Burgess and Cambridge. And Burgess and Cambridge Associates are two companies that are in the business of selling private equity. One of the things they do is to sell private equity indices to practitioners. And you can see that those numbers, their indices, look very much like the one we constructed. And I think, they don't reveal exactly how they construct their index, but it seems pretty obvious that what they do is since they don't have the secondary market data either, but what they do is they use the NAVs and you stick it into the formula, and you get very smooth lines because of the fact that NAVs don't move very much. They're book values. Beneath that is the public market, which is the dotted line, and beneath that is the S&P listed private equity. So what that is an index that S&P has created of the private equity funds that are publicly traded. So some of them are publicly traded. Now, this does not reflect the returns of an investor in any one of the funds, because these are the returns to the general partners, not the limited partners. But as you see, our returns sort of follow the listed public private markets more closely than the secondary market than the private equity indices. And it also, if you look around 2009, you can see that the secondary index that we created dropped by even more than the public market, although kind of comparable to the listed private equity funds. So anyway, so that is about, that is our index, and the message of the index is, we think that we can learn a lot about private equity values, returns, and risk by looking to secondary markets. Just like we do for bonds, right? So for bonds, again, we typically think about the returns on illiquid bonds. The way we measure it is by creating an index of the liquid bonds and using that index to price the illiquid bonds. The NAV-based indices, which are the ones that practitioners look at all the time, they tend to be too smooth, and they tend to overestimate beta, underestimate alpha, even adjusting for known smoothness. And so basically, we think that indices based on these secondary market prices are useful for measuring, for really understanding private equity performance, just as they are for other asset classes. Now, I told Michelle and Karen that I would talk for 45 minutes or so and then take some questions. So perhaps it makes sense for me to stop now and take some of your questions. So I don't know how you do this. So is there Michelle? Is there there's some questions in the chat, and
Yep. So we have questions in the chat. I don't know if you can see the question that we have in the chat. It says, may selling on the secondary market lead to less access to future private equity funds on the primary market? Or the other way around, getting into a fund on the secondary market may help in getting access on the primary market. Given that private equity funds prefer limited partners that can fulfill the capital calls or that provide stability. So the question is, does the secondary market lead to less or more access to the primary market?
That's a great question. I actually don't know the answer to that. I think well, I think the questioner, I don't know the questioner, he's asking, or it could be a she, is that does the secondary market influence the GPs in terms of who to give access to? And my instinct is maybe a little, but probably not that much. So perhaps they, I don't know what Sequoia or some of the really prestigious GPs would do if somebody sold their stakes. They might get mad at them and not give them access to their next funds. On the other hand, if it's Harvard or Yale that's selling, they probably wouldn't care. And if there's a buyer, I mean, maybe it would make the buyer, maybe it would make the GP more comfortable with giving the buyer more access to the next fund. So I think the questioner's instinct is probably correct. Other questions? Is there one is there Q&A button here? No, okay. That was from tech support. Any other questions? Oh, Michelle? Wait, can you hear me? Am I frozen? Michelle, can you hear me?
Yes, I apologize. My internet decided to cut out for a second.
Oh, okay. No, that's okay. I just feared that it was my internet that was cutting out, and so sort of.
No, that was the perfect moment for my internet to cut out.
So okay, so there are other questions out there. Do you know?
I don't see any other questions. If anybody else has questions, please drop them in the chat or Q&A. The person who asked that initial question about the secondary market leading to more or less access to the primary market was Dorian Bangshraf. And I am sure that I'm butchering your name. I apologize for that. If you want to clarify, I'm going to allow you to talk if you're interested at all.
Hi, Michael. Thank you very much for the presentation. Very interesting, especially this latter part where you try to infer from the secondary markets to create some sort of index on the pricing of the PE market. Now, so I think you correctly interpreted my question about this GP preference about allowing LPs to access their funds at later stages. I mean, I would assume that in those cases where the LPs get in liquidity needs, that 10% which you mentioned, then it may be more likely that this may be a bad signal to PE firms in a later stage. But I think you already completely answered my question.
Okay, I mean, I think ultimately, from a GP's perspective, you know, most GPs are very rational, and they basically they want to get a steady base of LPs. They care about their relationships with their LPs a lot, and the idea, you know, one of the drawbacks of selling one of the things that make it hard for them to sell stakes in their funds is the fact that these stakes are very illiquid. And so that if there's an intermediary like the one who provided us our data that's willing to transact stakes in their funds, they love that. And so they basically it allows them to sell stakes in you know, more valuable stakes in their funds to make them more attractive to their LPs. And so I think they normally don't really care, but perhaps they do. I don't know.
So Michelle, would it be okay if I ask another question?
Absolutely, please go ahead.
So Michael, so you showed in your graphs that the NAV doesn't drop dramatically. It's relatively smooth since it's a book value, and it's different for the secondary market. But it seems that especially around this crisis, there's a huge liquidity need where the discount is going to be much higher.
Right.
So I wonder how LP behavior, if you have any feeling of how LP behavior should change, because essentially if the values bounce back up quite dramatically right after the crisis, you obviously don't want to sell your stake in the private equity funds unless you really have to. And I'm not sure how it would work with these more smooth or less smooth valuations.
Well, I mean, you know, it's sort of hard to know what you say should, right? Because looking back on it, you know, we all should have bought, we all should have bought equities in 2009, and we also should all, you know, about a year ago when we were all freaking out because the stock market went down by 30 or 40% at the beginning of COVID, we all should have been smart and okay, we're going to buy Zoom stock and we're going to buy Apple stock, and we would have done, we could have quit our jobs, right, if we did enough of it, right? But looking back on it, is really not the right way to approach financial markets, right? I think that you know, at the time, people were kind of, you know, there was a big, you could say there was a big liquidity discount in the private equity market, but actually I'm not sure I look at it that way, because the public markets were declined too. So if public, you know, a year ago, and after the public markets went down a lot, was it trading at a discount, or was that just the right price, right? And so basically private equity is the same way, right? Was it trading at a discount, or is it the right price? What's happened is that looking back on it, the people who bought did really well. But, you know, again, looking back on history, we only observe history one time. History only happens once, right? So you know, from an ex-ante perspective, were they wrong to sell? Now, one of the things interesting that happened during the financial crisis that I just want to point out is that the discounts were huge. They were like 50%, but the volume wasn't that big. So I think what happened was that a lot of the institutions that wanted to sell, I think universities were the big players here, they basically wanted to sell at NAV or slightly less than NAV, but the market price was 50% of NAV, so they didn't sell a lot of the positions they wanted to sell, because that's just what the price was, because there weren't a lot of buyers out there then, right? I think that one of the things that's happened since 2009 is the market's become more liquid. There've been a lot more buyers. These funds of funds have been raised, and so you can't buy anything at a huge discount to NAV anymore, whereas you could in 2009. I don't know, did I answer your question? It was kind of a rambling answer.
No, sure, yeah, definitely. But I think the point was more towards the idea and the notion which you touched upon, that the PE funds that are generally raised around crisis periods or just thereafter generally perform pretty well based on historical performance.
Well, right, I have other papers about that, but that's not
the
secondary market.
No, that's true, but I would assume that if you figure out that this drop in the public market, or the secondary valuation is higher than in the NAVs, then LPs would be less inclined to sell their PE stake because they're overweighting in the PE market. But yeah, no, overall a very interesting presentation, and gonna think about it more. Thank you very much.
Well, thank you. So the original papers are on my website if you want to look at it. Okay. Any other questions or any other comments or?
I don't see any other questions here. We do have about 4 minutes left. So if you want to, this is an overview and research idea session. You've obviously you've given us a wonderful overview and talked about some things that, we still have yet to learn about secondary private equity markets. Do you want to end with any thoughts about what might be good paths for new research going forward in this area, whether, with publicly available data or the proprietary data that, you manage to get your hands on and, perhaps somebody else can try as well?
Well, I don't know. I mean, one of the things that I've observed in recent years is that private capital markets, the one rule I have about private capital markets is that they are at least as important as public capital markets, and they're way more interesting because all of the kind of all of our theories about microstructure and corporate finance and everything apply in spades and about private capital markets, right? So I mean, we had here a little of microstructure, a little bit of capital markets, and there's tons of issues in raising capital in corporate finance. So I think that thinking about different aspects of private capital markets is kind of a really great thing to do research-wise right now. Just because, I mean, the other thing that happens is that when you talk to practitioners, you just go to lunch with them and they start telling you, oh yes, you're interested in secondary markets. Well, we do that. But one of the things that this guy does was he just was telling me, some of them buy the tail end funds themselves. Some of them go and they just buy stakes in tail end funds and they get returns that way. So the market is changing like every day. And new funds are being raised to purchase all kinds of things. I assume there's new intermediaries that have entered the market, and so it's just kind of a fascinating market. Now it's frustrating. A lot of people who are PhD students and young faculty, they say, "Oh, well, private equity is interesting, but how can you get data? Oh, it's not on the CRISP tape. Oh, well, let's not worry about that, right? I mean, but it's one of those things where a lot of the most interesting things going on in the capital markets right today, and probably for the next 20 years, doesn't have to do with, is not based on data from CRISP and CompuStat. It's based on these private transactions that occur, and you can get data about the firms. It's just you have to be a bit more. You can't get this data we used here, but you can get a lot of data about buyout firms and about pipes and you name it. All the different kinds of deals from public sources. And I've done that in other papers and lots of other people have done that in other papers. So it can be done, but it requires a little more creativity. And but the thing about it is it really covers all aspects of the field of finance, the private capital markets, so any subfield that we study about public capital markets, you could study on private capital markets and kind of have it be far more interesting than about public capital, right? So in other words, when we think about microstructure, they talk about the difference between decimalization and how much transactions costs go down when they went from 10 cents a trade to 1 cent a trade. Well, we're talking about much, I mean, bigger trades. I don't have the numbers, but probably transactions cost of 10 or 20% of the value of the security. So there's huge transaction costs. And so thinking about the way these markets work is just kind of, to me, is really fascinating.
Yes, good point. Absolutely. Yeah, I think that, that should resonate with a lot of people. This really does cross a number of fields in finance, corporate, capital markets, microstructure. And I think the other point that you said that should be really well taken is that, this is really a topic that can open a lot of conversations between academics and practitioners. And practitioners, of course, can offer some of that data that could lead to really interesting research.
Oh yeah, that's one last thing I will say is that this is what Michelle said is really true. That there are a whole. To be honest, I prefer than going to these giant conferences, unless they're in like Cyprus or something like that, to go to these little practitioner conferences. And there's, they actually want to hear what we have to say, and they will tell us what we're doing right and what we're doing wrong. They'll tell us about the new trends in the industry. They will often be willing to give any data that they have. They just they love the interaction with academics. And so if you're like a doctoral student that doesn't know anybody, and you send an email to a GP saying, well, would you mind having coffee with me? You may think it's hopeless, but there's a decent chance they will say yes. Especially, if you send it to Steve Schwartzman, he's not going to want to talk to you. But if you send it to the young GP at the local the local venture capital shop in your city, he'll be flattered that you want to talk to him, and if he has time, he'll do it, right? So and you can learn a lot by talking to these people, and so in addition to being sort of great research, it's sort of great fun.
Yeah, absolutely. I hope that piece of advice is in your book.
Yeah. All right. It is actually. It is. Yeah. My book. Yeah. I talked about this. I think it is. Yeah.
If not, well, it'll be a different edition, right?
Yeah. If they ask me to do a second edition. Yeah.
Okay. Unfortunately, we are out of time. Mike, I don't know if you have time to join us in the reception. I am posting the URL to the virtual reception in the chat if anybody wants to continue conversations in that after the session. Mike, thank you so much for taking the time to speak with us today. I'm sorry we're not in Cyprus.
Oh yeah, it was not your fault. About one last thing, everybody, let's all make a resolution to visit Cyprus in person at some point in our life. So it's
yes.
So Michelle, I can hang out for a few minutes. I did make plans to actually see some of our doctoral students in a few minutes, but I can.
Okay, good man. Okay, so if anybody's interested, the URL to the reception is in the chat. Please feel free to click on that. Otherwise, I believe that we can, Karen, if you're there and you're listening, can you let us know if we can keep the Zoom open for a little bit, if Mike wants to hang out here?
Yeah, why don't I just hang out here for a few minutes, and if anyone wants to chat, I can.
Okay, yeah, I think that we can just keep it open, so I'll go ahead.
Michelle.
Yes.
I've got it open for another half hour.
It's open for a half hour?
Mm-hmm.
Okay. Although everybody here is not able to turn on their screen, are they?
No.
Okay. Mike, do you mind hopping over to the reception then?
Yeah, I can use for 5 or 10 minutes, and then I actually realize I have to.
Okay, that sounds good.
So I click on this gather.
The GatherTown link. And anybody else who's in here, meet Mike over at the GatherTown link. That way you'll actually be able to see everybody.
Okay, hold on. Wait, what am I supposed to do? Michelle?
Yes.
Oh, so are we at GatherTown link or something?
Yes.
Okay.
Are you there?
Yeah, I'm here. Is anyone else here?
Let me get myself in there.
Well, you can still. Are you talking to me through Zoom or through GatherTown link?
I'm talking to you through Zoom right now, and I'm hopping over to GatherTown. You're still on Zoom.
Should I leave Zoom?
Michelle and Mike, I think you have to leave Zoom in order to use your camera and Gather.
Okay, I will leave.
It gets a little confused.
Okay. Okay, meet us over there if you want to continue to talk with Mike.